Hello, I'm Julie Price, and welcome to Juniper's Economic and Market Review as of December 31st, 2023. Thank you very much for joining me. At the start of last year, many investors and economists worried that 2023 would be a challenging year for the economy and markets. Instead, 2023 turned out to be a year of surprising resilience. Growth accelerated to 5.2% during the third quarter, while inflation continued to slide toward the Fed's 2% target. Looking ahead, the economy should slow in 2024, and a soft landing still looks possible. However, with fading tailwinds from consumer and business spending, slow momentum does leave the economy vulnerable to any kind of shock. Meanwhile, after hiking rates by a cumulative 5.25% over the last 2 years, the last of the Fed's rate hikes is likely behind us. At its December meeting, the Fed kept rates unchanged, and forward guidance indicates that rates are at their peak. That said, the Fed is still firmly pushing back against any notion of early rate cuts, raising the risk that rates will stay higher for longer. Ultimately, this will depend on whether or not the U.S. economy falls into a recession. Despite Fed tightening, equity markets saw impressive gains last year with relatively low volatility. The same cannot be said for bond markets, which grappled with elevated interest rates and supply imbalances. As investors look forward to 2024, geopolitical uncertainty remains elevated. However, valuations outside of the largest stocks look attractive, while fixed income offers strong asymmetric returns. 2024 could be another year of surprises, but leaning into active management and stepping out of cash should help investors take advantage of the changing investment climate. JP Morgan devised a great way to summarize their forecast of 2024 using the numbers 2, 0, 2, and 4. 2% is how much they forecast GDP to grow in 2024. It is an estimate of moderate growth, which is what they've been predicting for some time now. 0 is for a zero chance of recession, my favorite prediction for 2024. This means that we might just see the soft landing that analysts have been theorizing. The second 2 is a prediction of 2% inflation by year end, which would compel the Fed to cut interest rates. And finally, JP Morgan predicts 4% unemployment, so far below the long-term average of 6.5%. In this quarter's Economic and Market Review, we assessed the performance of this past year for the markets and economy, considering trends in growth, jobs, and inflation, and how these trends are shaping the outlook for monetary policy. This is followed by comments on growth from around the globe. Finally, we consider the implications of all this for those investing across asset classes and highlight the importance of stepping out of cash for longer-term investors, the importance of taking a balanced view toward asset allocation, and actively managing risks within a portfolio. Any investment strategy should start with a broad assessment of these fundamental issues. To help us out, we turn to JP Morgan's Guide to the Markets. Feel free to pause the video and read the slides as you join me while I discuss these topics and more. The U.S. economy saw impressive resilience last year, with the first 3 quarters showing above-trend real GDP growth. Easing inflation and improved prospects for growth have helped fuel optimism for a soft landing. However, a quick look across each sector of the economy tells us that economic momentum in the year ahead is set to be moderate at best. Business spending held up better than expected last year despite tighter lending standards, supported by increased spending on intellectual property and with greater emphasis on building and integrating artificial intelligence capabilities. Tailwinds from AI spending, as well as federal government support for semiconductor manufacturing, should persist in 2024. However, increased caution among lenders and slowing corporate profits could still constrain growth in capital expenditures. Consumers have remained resilient, supported by a tight labor market and rising real wages. However, there are some signs of weakness. While revolving credit as a share of disposable income does not look overextended, delinquencies are rising and younger households are showing signs of increased financial stress. As labor market conditions continue to loosen and lending standards remain tight, consumer spending should grow at a slower pace from here. The housing market appears to have stabilized, albeit at low levels, as tight housing supply and steadying mortgage rates are signaling that the worst is behind us. Trade should be a mild drag on the economy, as the still strong dollar and sluggish global growth weigh on exports. Meanwhile, government spending growth should slow as gridlock in Washington limits further stimulus. Overall, the U.S. economy should continue to grow at a moderate but slowing pace from here. That said, a slower moving economy will be increasingly sensitive to shocks, whether it be at the U.S. election, higher policy, significant geopolitical tension, or something entirely else. Risks remain that could still push the economy into recession in 2024. After a red-hot labor market sent wages higher and brought unemployment all the way down from a height of 14.9% at the onset of the pandemic to its 50-year low of 3.5%, the labor market is now getting back to normal. Unemployment remains at 3.7% as of December, despite swift declines in job openings, and has hovered between 3.4% and 4% for the last 2 years. However, cooling labor market conditions are evident in private sector wages, which have moderated from a peak of 7% year over year in March 2022 to 4% this past November. While this is still above its long-term average, wage pressures are receding, with quits falling and businesses reeling back hiring efforts in the face of slowing consumer demand. It's also worth noting that while strikes have made a lot of headlines in the last year, less than just 6% of the private sector workforce is represented by a union, and this is down from 20+% in the 1980s. On balance, we aren't worried about wages contributing to higher inflation, and in the absence of a recession, unemployment could remain stable as well. U.S. businesses still face structurally slower labor force growth than in prior decades, with census projections showing the population age 18 to 64 will rise only 0.1% in 2024. Tight labor markets could encourage more immigration or further gains in labor force participation, but excess capacity may be limited. Overall, a combination of subdued job growth and slowing wages should give the Federal Reserve further confidence that inflation is sustainably coming down. Resilience in the U.S. economy has also been shared by corporate America, with earnings growth surprising to the upside last year. Revenues were the largest contributor to earnings, with consumer strength and pricing power allowing companies to boost sales. Margins, or profits, however, have detracted from earnings as companies grappled with higher input and labor costs. Still, companies have been active in defending margins by cutting costs and adopting more efficient digital capabilities, helping margins stage an impressive recovery in the third quarter. Looking on to 2024 and 2025, expectations for double-digit earnings growth seem to be too optimistic, as defending profit margins will become increasingly difficult in an environment of slowing economic growth and waning pricing power. However, high-quality companies with strong balance sheets, ample cash balances, and sustainable earnings should perform well relative to the broader index. After inflation reached 50-year highs in 2022, the inflation heat wave met a cold front in 2023, with headline CPI easing to 3.1% year over year in November, well below the 9.1% peak reached in June of 2022. While it is still above the Fed's 2% target, the underlying components of inflation provide the confidence that this downtrend has room to run. Core goods prices trended lower in 2023 as supply chain distortions related to the pandemic and Russia's invasion of Ukraine continued to fade. Meanwhile, the more volatile components, mainly energy and food prices, also provided an important source of disinflation amidst slowing demand. Absent any supply shocks or unexpected surge in demand, these categories should continue their descent in the coming months. Lastly, shelter inflation, which accounts for a third of the CPI bucket, is predictably falling. The remaining problem for inflation, therefore, is core services prices outside of housing, which the Fed has honed in on when referencing persistent inflation. However, as we show on the right-hand side of the slide, inflation in this measure is mostly just transportation services, which includes things like auto insurance and auto repair costs. Going forward, the rollover in vehicle and auto part prices should feed through to this category, and combined with easing wage pressures and cooling consumer demand, services inflation should fall further in the year ahead. Overall, inflation made impressive progress toward the more normal levels in 2023. While we are not yet quite back to the Fed's 2% target, getting down to 2% by the middle of 2024 looks in reach, and this should give the Fed assurance that inflation is under control as they debate easing monetary policy. The Federal Reserve has hiked rates by a cumulative 5.25% since the beginning of 2022 to combat inflation. However, with inflation steadily trending back towards their 2% target and labor market conditions easing, the July rate hike was likely the last of the cycle. At their December meeting, the Fed voted to leave the federal funds rate unchanged at a target range of 5.25 to 5.5% as widely anticipated. Forward guidance acknowledged the progress made in cooling both inflation and labor markets, but maintained a hawkish bias, likely in an attempt to temper dovish market expectations. Specifically, the Fed's dot plot continued to suggest rates will remain higher for longer, with the median FOMC member expecting limited easing in 2024. However, there appears to be some diverging opinions amongst the committee pertaining to the future path for policy. Updates to the summary of economic projections reflect a confidence in a soft landing scenario, and the Fed appears to acknowledge that inflation has fallen faster than expected despite economic resilience. Overall, the Fed is more likely than not at the end of its hiking cycle, which means investors are now more interested in the timing and extent of eventual rate cuts. If the economy remains afloat, the Fed may only deliver minor policy cuts. However, if the economy enters a recession, the Fed may be forced to cut rates more aggressively to try to stimulate the economy. Either way, it looks increasingly likely that rates will move lower in the year ahead, but they still may settle at a higher level compared to previous policy easing cycles. Despite negative headlines, the global economy proved to be more resilient than expected in 2023, but some countries clearly did better than others. The Eurozone, UK, Canada, and China struggled, while the US, Japan, and emerging markets outside of China were stronger, as evidenced by their composite PMIs remaining above 50 for much of last year. In China, depressed consumer business confidence continues to challenge growth, while the full effects of stimulus measures from the policymakers have yet to be realized. China's weakness also spilled over to Europe, which is similarly experiencing weak domestic consumption and elevated manufacturer pessimism. Activity is now showing signs of stabilizing, albeit at low levels, and there is hope for a modest reacceleration in Europe falling inflation boosts real incomes. Elsewhere, India continues to see strong growth, supported by its growing middle class and government support for private businesses and digitalization. Global growth should be less divergent in 2024, with the U.S. economy slowing down and China's economy stabilizing. However, the key question is how much this gap will close and whether it is more due to a U.S. slowdown or a pickup in overseas growth. In bond markets, volatility was a defining feature of 2023 as investors grappled with resilient economic data, a hawkish Fed, and various technical factors. The yield on the 10-year Treasury climbed by nearly 170 basis points, from early April to late October before expectations for a soft landing and an end to tightening helped drive the yield lower by more than 70 basis points in less than 2 months. Even with this move lower, current yields across the fixed income landscape still offer investors much better income and total return opportunities than existed a year ago. This slide shows yields across fixed income sectors relative to the last 10 years, and nearly all sectors are trading well above their 10-year median yields. Simply sticking with core fixed income provides attractive yields above 5%, while leaning into riskier asset classes like high yield can provide yields north of 8%. Moreover, with peak interest rates likely behind us, bonds also offer the potential for price appreciation in the event of lower rates and diversification benefits if lower rates coincide with recession. This potential for asymmetric return in bonds may not last long, underscoring the importance of leaning into fixed income while yields are at these elevated levels. After a very troubled year for investors in 2022, U.S. equities rallied strongly in 2023, largely recovering their losses in the prior year. This performance owes to a combination of better-than-expected consumer spending, resilient corporate profits, and enthusiasm around the advancements in AI. However, equity market performance was not broad-based, with the largest stocks in the index accounting for the majority of gains. On the left, we show stock market performance since the start of 2023, and the top 10 stocks have accounted for roughly 90% of price returns, leaving them 1.4 times more expensive than the broader market. Meanwhile, the remaining stocks are up only by low single digits and are trading cheap relative to the broader index. Index concentration is not a new phenomenon, as the weight of the top 10 stocks in the S&P 500 has been rising since 2016. The earnings contribution from those stocks hasn't kept pace and hardly budged last year despite strong asset price appreciation. The fact that the top 10 stocks now make up a third of the index but only account for a fifth of the earnings of the index suggests significant mispricing in the stock market. In 2024, if economic growth remains positive and technological advances yield significant productivity gains, markets could still perform well, but gains should broaden out beyond the largest names. In environments like these, active management may identify those companies with sustainable, high-quality earnings that are being overlooked by the markets. So what are growth and value stocks? Growth stocks are shares of companies expected to grow rapidly, often reinvesting earnings to fund expansion. Value stocks are shares of undervalued companies considered bargains based on fundamentals like earnings and dividends. Investors often ask whether they should invest in growth or value. My response is that you actually want to hold both types of stocks. On the right side of the chart, we look at total returns categorized by interest rates as measured by the 10-year bond. On the left, where we have a low interest environment, growth stocks perform better than value. And that's where we were at in the last decade. Currently, we are here in the middle, where bond yields are hovering in the 3 to 4% range. So allocating to both growth and value makes sense for where we are at right now. Strong equity market performance in 2023 was not only a U.S. phenomenon, as international equities also experienced impressive growth, with the MSCI All-Country World Index climbing more than 10%. Taking a quick trip around the globe, Japanese equities had a very strong year, rising nearly 16% in dollar terms, as an improved interest rate backdrop and corporate governance reform propelled new enthusiasm from investors. Elsewhere, promising fiscal reforms and strong economic momentum bolstered the case for Indian equities, which similarly rose over 16%. In Europe, markets also saw strong performance in the first half of the year as the end of negative interest rates supported banks and economic activity stabilized from Russia-induced energy shortages. Looking ahead, while the global growth backdrop looks set to slow, there are still strong opportunities outside of the U.S. for long-term investors and at better valuations. Indeed, international equities continue to trade at a steep discount of over 30% compared to U.S. equities, near 20-year lows. International equities also offer greater income with dividend yields trading at a 1.8% spread above that of U.S. equities. Combine this attractive entry point with structural tailwinds, attractive relative fundamentals, and a weakening dollar, and the year ahead could be a much more favorable environment for U.S.-based investors investing overseas, looking to diversify and add exposure to important global secular trends and themes. Policy tightening from the Fed has pushed yields on cash-like instruments to their most attractive levels in over a decade. With yields north of 5% and minimal risk, many investors have decided to allocate more heavily to cash. However, history shows that staying parked in cash after the peak in interest rates usually leaves money on the table. In the last 6 rate hiking cycles, the U.S. aggregate bond index outperformed cash over each of the 12-month periods following the peak in CD rates, while the S&P 500 and a 60/40 stock bond portfolio outperformed in 5 of the 6 periods. This is not to say that investors should abandon cash altogether, as liquidity is an important allocation in any portfolio. However, there is an opportunity cost in holding on to too much cash, and investors should put long-term money in long-term assets. Following the peak in interest rates, there has always been a better asset than cash to deploy capital. With 2024 being an election year, it's an appropriate reminder to not let politics affect your decisions of whether or not to stay invested in the market. This chart shows consumer confidence by political association rated as excellent or good. During the Obama era, Republicans did not feel positive about economic conditions, with only 5 to 20% ranking the economy as good or excellent. By contrast, Democrats felt more positive with 5 to 45% higher ratings. During this period, the market had an average annual return of 16.3%. However, in the Trump era, Republican sentiment outweighed Democrats, while the market returned 16% annually on average. This pattern is really strong, so be careful to not let politics affect your investment strategy. Here's another chart that looks at the economy in years of Republican rule, Democratic rule, and divided government, years in which no one party controlled both the executive and legislative branches of government. The top chart shows annual real GDP growth, and the bottom chart shows calendar returns for the S&P 500. Most of the time, the U.S. had a divided government, shown in gray. Under all 3 scenarios, the U.S. has seen strong economic growth and market performance. There is no strong pattern of any combination of political rule that can predict the future of the economy. So as this election year progresses, investors would be advised to not tie a political party to economic performance. And to wrap up this quarter's review, we look at the matrix as of December 31st, 2023. U.S. large-cap equities came out on top for 2023 with a 26.3% return. This was followed by developed market equities at 18.9%. High-yield bonds persevered in a tough fixed-income environment, ending the year up 14%. Real estate was heavily battered in 2023 in a high-interest environment, down 5.6% year-to-date in the third quarter, but ended up the year up 11.4%. Fixed income also rallied strongly in 2023, up 5.5% for the year after being down 1.2% year-to-date at the end of the third quarter. There you have it, this quarter's economic and market review. Thank you very much for making it all the way through this quarter's video. As always, please feel free to reach out to me to review this and more.